History's great empires have all promised one thing: the absolute security of their money. Governments repeatedly assure us their systems are built to last. Yet, across centuries and continents, this promise has been broken every single time. Consider the arc of history, from the Roman denarius to the French assignat, from Confederate notes to the modern Lebanese pound. In each case, everyday citizens awoke to a devastating truth: their savings had turned to dust, their paychecks were rendered meaningless, and the futures they had carefully built were stolen by the institutions they trusted most. These events reveal a difficult truth: financial collapse is not some rare anomaly. It is a recurring feature of human civilization. The real question, then, is not whether systems will fail, but what you do to protect yourself when they inevitably do. Believing in the false permanence of any financial system isn't just optimistic, it's the most dangerous mistake an investor, saver, or citizen can make. We check the numbers in our bank accounts, we hold our national currency in our hands, and we instinctively believe they are as solid as stone. But money itself is not stone, it is trust given physical form. And trust, as history shows, can disappear in an instant. This is precisely why the past is both so harsh and so valuable. Each economic failure, every currency collapse, leaves behind a clear set of clues. These are patterns that show us what truly holds value when paper wealth fades, and what simply turns to dust. If you study these moments closely, you will notice a consistent truth: those who made it through weren't the ones with the most faith in the system. They were the ones who understood its fragility before it was too late. The survivors were always those who questioned early. Consider the Byzantine Empire, the eastern remnant of Rome that outlived the West by nearly 1,000 years. Its economic strength rested on the gold solidus, a coin so trusted that it served as the medieval world's de facto global currency, accepted from European markets to Asian trade routes. Yet even Byzantium repeated the mistakes of its predecessor. Rome had already demonstrated the peril of debasing currency, slowly replacing the silver in its denarius with base metals until it became little more than washed tin. You would think Byzantium had learned. But as longtime followers of this channel will recognize, history's lessons are often observed, not applied. We've seen this pattern before. Yet, centuries later, the Byzantines repeated the very same error, this time, with gold. They began to quietly reduce the purity of the solidus, thinning it out, mixing in lesser metals. At first, the difference was subtle. But soon, confidence began to fracture. The coin that had once unified Mediterranean trade became just another instrument of political fiction. The debasement shattered its credibility, and with it, the Byzantine economy lost the foundation it had stood upon for centuries. So what endured? Not official promises, not imperial decrees. The ones who preserved their wealth were those who had quietly accumulated real gold or secured land beyond the empire's direct control, while everyone else watched their prosperity vanish into air. This reveals the first enduring lesson: those in power consistently yield to the temptation to devalue their currency. And when they do, genuine wealth migrates to assets they cannot easily replicate or manipulate. Yet not every collapse stems from deliberate monetary policy. Some arise from sudden, external shocks that reshape society overnight. Consider the mid-14th century, when Europe was ravaged by the deadliest pandemic in its recorded history, the Black Death. Between 1347 and 1351, nearly half the continent's population perished. Cities grew silent, villages disappeared, and trade networks shattered. But the economic narrative of the plague is more nuanced than pure devastation. When half the workforce vanishes, labor itself becomes a scarce and valuable resource. Those who survived could now command higher wages. Food and land, once fiercely contested, became relatively abundant compared to the number of people left to claim them. Families who held silver, tangible goods, or even just the capacity to labor found themselves in a position of unexpected leverage. Properties that were once unattainable could now be acquired for a fraction of their former cost. Homes stood empty, fields lay fallow, and those who remained suddenly found themselves in a buyer's market. If this sounds hauntingly familiar, it should. During the COVID-19 pandemic, we witnessed a modern replay of this dynamic. Global supply chains buckled, governments unleashed trillions in newly created currency to prevent economic paralysis, and a stark divide emerged. Those with capital and liquidity moved quickly, acquiring real estate and assets, while those living income to income fell further behind. In the United States, housing prices climbed sharply, and stock markets rebounded with remarkable speed, yet millions struggled simply to pay rent. The pattern is unmistakable: pandemics have always reshuffled wealth. Just as survivors of the Black Death used newfound leverage to rise economically, those with financial means during COVID invested in property, equities, and enterprises that others were forced to relinquish. The lesson is unsettling but undeniable: crises amplify advantage. Those with reserve seize opportunity, those without face erosion. And while pandemics reveal how suddenly an economy can turn, the collapse of Renaissance Florence's banking system teaches something equally critical: even institutions deemed too big to fail can crumble in sequence. In the 1340s, Florence stood as Europe's financial heart, dominated by powerhouse banking dynasties like the Bardi and Peruzzi. These banking dynasties had extended enormous loans to monarchs, most catastrophically to England's Edward III, who repudiated his massive debts during the 100 Years' War with France. When the king defaulted, the banks imploded. Ordinary depositors were wiped out. Commerce ground to a halt. Florence, once the vibrant center of European finance, plunged into economic chaos. The common citizens who had placed their trust in these prestigious institutions learned a brutal lesson: size does not ensure safety, and reputation offers no protection. The takeaway: too big to fail, is a myth as ancient as banking itself. Financial institutions are designed to generate profit, not to safeguard your well-being. When they collapse, they will inevitably take your wealth down with them. This pattern echoes through the centuries, from the Florentine banking crisis, to the Lehman Brothers collapse in 2008, to Lebanese banks freezing depositor accounts in 2019. Those who survive understand one fundamental truth: an institution's guarantees are only valid until the moment they're not. The American Civil War is rightly remembered for its battlefields, its political divisions, and its fight over slavery. Yet behind the front lines, a parallel financial war raged, one that reshaped the very meaning of money. Both the Union and the Confederacy faced a stark reality: modern war is expensive, and to fund it, they turned to the printing press. The Northern government introduced greenbacks, paper currency backed not by gold, but by faith in the Union's future. Initially seen as a patriotic measure, this move soon revealed its consequences. As more greenbacks entered circulation, their purchasing power fell. Inflation set in, and public confidence began to slip. In the South, the situation grew even more dire. The Confederacy, starved for resources, churned out graybacks in overwhelming volumes. By the war's end, Southern inflation reached catastrophic heights, prices soared by thousands of percent, a soldier's monthly pay could barely buy a loaf of bread, and for many, a lifetime of savings turned to dust in their hands. Families needed entire bags of banknotes just to purchase a single loaf of bread. By 1865, Confederate currency wasn't merely weak, it was utterly worthless. In that collapse, what retained value wasn't paper promises, but tangible assets: land, food, gold, anything physical and real. For average Southern families, the result was devastation: lifetimes of savings evaporated into nothing. Yet for those holding real goods, the crisis became an opportunity to acquire property and wealth at desperate, bottom-level prices. It's a chapter of American history seldom emphasized, but vital to remember: the United States has already experienced a total currency failure. And when it happened, true security came not from paper money, but from owning what the system could not devalue. France provides another stark lesson in how quickly money can disintegrate, this time during revolution. In the 1790s, after overthrowing the monarchy and seizing church properties, the new government issued a paper currency called assignats. These were theoretically backed by the value of confiscated lands. But rather than stabilizing the economy, the authorities printed these notes excessively. Each new wave of currency further diluted its value. Prices skyrocketed, wages couldn't keep up, and soon the assignat became completely worthless. Farmers refused to accept paper money for food, demanding payment in silver or goods instead. In Paris, bread riots erupted again as the revolution began consuming its own children. The real winners in this collapse weren't those holding revolutionary paper currency. They were the people who possessed food, gold, or property, assets the government couldn't simply print. For ordinary Parisians, the lesson came too late: promises, however noble sounding, are only worth what others are willing to accept for them. When public trust evaporates, your savings don't just diminish, they disappear entirely. 2 centuries later, we saw this same pattern replay in Asia. In 1997, what started as a speculative attack on the Thai baht exploded into a full-blown regional crisis. Thailand had accumulated massive dollar-denominated debts, confident its currency peg would hold. When that peg shattered, foreign currency debts became impossible to repay overnight. Investors panicked and fled. Currencies across Southeast Asia, in Indonesia, Malaysia, South Korea, collapsed in a devastating domino effect. Economies contracted violently, unemployment surged, and governments turned to the International Monetary Fund, pleading for bailouts. But those who suffered most weren't the international hedge funds that triggered the crisis, it was the ordinary people, shopkeepers, factory workers, families who saw their savings evaporate, their mortgage payments double, and their jobs disappear. Yet the outcome felt hauntingly familiar. Those who held US dollars or had moved assets overseas weathered the storm far better than those who kept faith in their local currencies. Nations drowning in foreign debt imposed severe austerity measures, while large financial institutions from the West acquired Asian companies and properties at bargain prices. What was framed as a regional economic crisis was, in reality, a massive cross-border transfer of wealth. The lesson reverberates from Byzantine gold to Argentine pesos. Borrowing in a currency you don't control is a fatal gamble. When financial hurricanes strike, it's not the lenders who sink, it's the borrowers. The pattern is now unmistakable. From revolutionary France to Civil War America to modern Asia, the same story repeats. Paper money fails. Debt enslaves both nations and households. And those who emerge intact are never the ones who placed the most faith in the system. They are the ones who understood its weakness before it shattered. Perhaps the most unsettling lesson of history is that financial collapse isn't confined to the past or to faraway places. It is unfolding in real time. Consider Lebanon from 2019 to 2021. There, banks took an action that still seems unimaginable to many in the developed world. They simply locked their doors. Ordinary citizens awoke to find their bank accounts frozen, their withdrawals severely restricted, and their national currency in freefall. The Lebanese pound lost more than 90% of its value. A lifetime of diligent saving was reduced to the equivalent of spare change. People lined up outside bank branches, pleading for access to their own funds, only to be told that their money was no longer available. This didn't just affect a few small depositors. Middle-class families, retirees, doctors, and engineers, anyone who had trusted the financial system, found themselves completely wiped out. The lesson was harsh but unambiguous. The money you keep in a bank is not a locked treasure vault. It is, in essence, a loan you have given to that bank, an institution that can decide during a crisis not to return it. Those who fared best were individuals who had diversified their holdings internationally, owned tangible assets like gold or real estate, or held physical cash outside the banking system. Everyone else found themselves trapped. If this feels like a distant problem, it shouldn't. In 2008, Americans saw their homes foreclosed and their retirement savings devastated, even as the very banks that caused the collapse received government bailouts. In 2020, during the pandemic, trillions of new dollars were created to sustain the economy, a rescue effort that inflated asset values for the wealthy but left ordinary incomes behind. Then in 2023, several U.S. regional banks failed within days when depositors lost faith, proving that the idea of too big to fail is a comforting story we tell ourselves, until the doors suddenly close. So the urgent question remains, how do you truly protect yourself when the system fractures? History offers no one-size-fits-all solution. In Byzantium, security meant gold. After the Black Death, it was having cash to acquire abandoned land. In Renaissance Florence, it meant distrusting bankers deemed too big to fail. In the Confederacy, survival depended on holding hard goods. In revolutionary France, it was food and property. During the Asian financial crisis, it was avoiding debt denominated in foreign currencies. In modern Lebanon, it meant moving wealth out of the banking system before access was frozen. The methods differ, but the principle remains unchanged. Survival doesn't come from trusting paper promises or powerful institutions. It comes from understanding what holds real value when the illusion of stability shatters. Here is the paradox we must grasp. Collapse is both a catastrophe and an opening. For those caught unprepared, it brings ruin. But for those with resilience, available capital, or assets that can't be devalued by the printing press, it becomes a chance to build wealth at a fraction of its previous cost. After the Black Death, surviving peasants became landowners because fields were plentiful and laborers were scarce. After 2008, those with cash on hand purchased homes as foreclosures swept the nation. True protection, then, isn't just about shielding what you have, it's also about placing yourself to acquire what others are forced to surrender in distress. Yet wealth isn't solely measured in what you possess. It also lies in what you can do. The true survivors throughout history weren't only those who stored gold or held deeds. They were the ones who could generate value when others couldn't. The baker who still produced bread, the artisan who repaired tools, the farmer who fed a community, the trader who moved goods across borders. These were the people who didn't merely endure collapse, they thrived within it. In every crisis, the value of paper money fades, but the value of real goods and essential skills does not. People still need to eat, to build, to heal, to trade. Those who can provide these fundamental needs rarely remain poor for long. That is the ultimate form of protection, not blind faith in governments or banks, but a practical mix of tangible assets, useful skills, and the clear-eyed understanding that all financial illusions eventually shatter. Every crisis is, at its core, a transfer, from the many who trusted blindly to the few who prepared thoughtfully. From paper promises to tangible value. From passive savers to active builders. History doesn't repeat exactly, but its patterns are undeniable. The real question is not if the system will falter, it always does. The question is whether you will be left holding empty promises, or something real. If this perspective resonated with you, consider subscribing. History holds the clues, let's continue learning from it, together.